understand, is progressivity itself helpful in kind of phrasing fiscal capacity? And it's with a group of co-authors, Gabe Turek at UC Davis, Arthur Laroche, who is a PhD student at UCL, Joanna Naritomi at LSE, John Weigel at UC Berkeley, and Marianne Goma at the World Bank. And you'll see why we needed so many co-authors. There's quite a lot going on. Okay. And so the motivation for this talk is, if we step back a little bit and think about the history of the emergence of fiscal capacity, what we see is that progressivity typically is an important moment for the emergence of tax states and states with large fiscal capacity. So for example, the personal income tax is an important moment where you see a lot of emergence of fiscal capacity that goes hand in hand with the introduction of a very progressive instrument. The second important thing is that progressivity is still an important feature of high-income countries today. So if you look at a very simple kind of correlation between tax revenue in percentage of GDP, so kind of tax capacity, and progressivity on the x-axis, you see a positive relationship. So in other words, countries that have high capacity today tend to have a more progressive tax system. So that's one aspect of our motivation. The second one was to kind of step back and think about, okay, so what's happening beyond kind of high-income countries in those contexts where we have lower progressivity, so kind of this set of countries here. Why is it that they have less progressive tax system? And I shouldn't have animated this, so I'm going to show you all the reason, because some of it is exactly what Michael talked about, right? There's good reasons to have people oppose a progressive tax system for political economy reason. For example, the elite or the bureaucrats, but they might refuse it. For example, if the regime is non-democratic, the elite might not support taxing themselves more, right? There's also economic structure reasons. It's harder to implement a progressive tax system with lots of informal economic activity. So there's a large literature in public finance on this. And the last one is going to be typically that Michael hinted at throughout his talk, is that it requires some tax administration capacity, right? So implementing a progressive system requires information, it requires bureaucrats that do the job, it requires enforcing the progressive system, and so that's going to also lead governments to shy away from progressivity, and typically what we see in lower income countries, lower capacity setting, is the implementation of fairly regressive taxes that are called presumptive tax. And so the idea is you're trying to tax an asset, let's say a property, you don't have a sense of how it's valued, and so you're going to rely on simple observable characteristic of that property, for example, the material of the walls or the material of the roof, to tax it. But that's going to generate progressivity within those broad categories. Okay. By the way, don't worry, I won't go through 40 slides. I will skip this is the maximalist version of the talk. I'll skip quite a few things along the way. So what do we do? And so what our project is trying to understand the role of progressivity for the emergence of fiscal capacity and whether introducing progressivity in lower income country actually can work, even despite those roadblocks. So, that's what we do. We ask, well, can progressivity raise capacity in low income countries? And to answer that question, what we leverage is a quite unique experimental design where we worked in partnership with the local government to randomly assign property tax schedule, okay? And so in particular, we work with the provincial government of Kasai Central in the Democratic Republic of the Congo in the context of the 2024 property tax campaign, so pretty recent randomized control trial. And this was enabled, like kind of echoing what I just said about one roadblock to progressivity being bureaucratic capacity. It was enabled by a technological reform, which was that the government implemented a citywide mass assessment of the value of all the properties in the city. Okay? And so we worked in partnership with them to establish that in 2022 and 2023. And so what we did is we worked with the government to randomize the 460 neighborhoods of the city to different tax schedules. Okay? And so the key ones I'll talk about in this presentation are the progressive tax schedule. So you should think of it as a system of increasing tax rates by value bands. And we're going to contrast it with a proportional system where that tax rate is actually constant. Okay? We have a set of neighborhoods that I won't talk about much that were kind of the status quo, this kind of presumptive tax that was fairly regressive and a set of fixed fee. that was mostly for the government to kind of have a sense that this was indeed doing poorly, not so much that they wanted to think about it hard, they wanted to move away from it kind of permanently. And so one key design feature we thought hard about is that in order to be able to evaluate, so a key object that we'll compare is progressive and proportional. In order to compare them kind of one-to-one, we wanted them to look kind of the same ex ante in terms of their revenue potential, okay? So we wanted to have a system where the revenue potential was the same. And what it means is that when we evaluate them, we're essentially rotating the curve, okay? So we have, like, you should think of the control group as being this blue line here. So that's the proportional system that taxes at a flat rate in percentage of the value of the property. And what we did with the progressivity system is we rotated that curve, okay? So some people in the property value distribution are facing a lower rate, so they get a tax cut, while people at higher property value get a higher tax rate, okay? And so this is a little bit technical, but in order to evaluate this reform carefully in terms of what it means for revenue, you have to think about all the different components that are happening kind of throughout the property value distribution, okay? And so the first thing you should think of is what in PF, in public finance, we call mechanical effects, which is we, for now, just hold behavior constant. We just assume people are not changing their compliance behavior as the tax rate changing. This is simple. When you have a progressive system, at the top, if we go back to that curve, those people are facing a higher rate. And so, you know, if people are not changing their behavior, you just get more money. And so that should increase revenue. At the bottom, if people are not changing their behavior, rates are lower. And so you're getting less revenue. Okay, so that's the easy part, and that's the known part. However, in order to evaluate that reform fully, you have to think about the other aspects that are changing, which is people might start changing their behavior. So that's in PF, it's called the behavioral response to change in tax rates. And people might change their behavior in response to their own rate that they're facing. And in particular, at the top, people are facing higher liability. They might start lowering their compliance. Some of them will decide not to pay. That will hurt revenue. Well, at the bottom, some people might decide they'll start complying because the rate they're facing is lower. That might increase revenue through this higher compliance. There's another aspect to it that I'll talk a bit in the second part, which is that people might start changing their behavior, not just in response to their own rate, but to the full schedule, the progressivity of the schedule. So some people might learn that the schedule is progressive, and they might like that. That will lead them to comply more, which is good for revenue. So that's an optimistic take. On the other hand, you could think that maybe people at the bottom will like the progressivity schedule. They realize that there's a cut and that they're facing lower rate. And so that might induce them to pay more, but maybe people at the top that are seeing this progressive schedule think it's not such a good idea and that they're facing higher rate. And so that might lead them to comply less. So this bit is quite ambiguous ex ante, okay? And so that's what we're going to try to parse through the presentation. In order to identify the difference in response to own rates versus other rates, what we'll leverage is more randomized controlled trial. We work with a government to actually provide information to a subset of property owners about the progressivity of the system. So we'll have a lot of figures, and we had to grapple with some of the things Michael discussed, that it's a hard concept to understand, progressivity. So we actually did it twice in order to be sure that our results were solid. Twice on the bill, and we did it more in the survey. Okay, so and that will help us separate the response to own rate versus response to other rates. Okay? So this is the part I'll skip. So let's see the slide number becoming less daunting. So what's the context? So a little bit about context and design. So we're going to study a reform that happened in the city of Kananga in the Democratic Republic of the Congo. It's the 4th largest city in the country. And you should think of it as an urban poor setting, despite being a city. People live on average below the poverty line. It's a context where fiscal revenue are extremely dire. So when we started working with the government almost like a decade ago, the number we got was the government is raising less than $1 per person per year. Okay, so that's the budget. That means that's the budget they can spend on their citizen. Things have changed since 2015, thankfully, and in part because the government has invested a lot of effort in the property tax for reasons, relate to some of Michael's a response earlier, why the property tax? It's a context where there's a lot of informality. Income tax is really hard. And so the advantage of collecting through the property tax is it's easy to tax. You can visit properties. It's very hard to hide your property from, you know, a drone flying above the city or from tax collector visiting you. So there's definitely some kind of first order reason to want to tax properties. Okay. And so how does the government do it? Well, it's doing door-to-door tax campaign. There's few kind of other, there's a still heavy kind of cash payments. And so you should think of the properties being visited by tax collector in person to give them their tax bill and then to kind of convince property owners to pay. It's still a context where compliance is very low. Okay, so we're going to start with a base rate of about 10% of people paying the tax, and we're trying, like, the goal is to get that higher through different reforms, including the progressivity of the system. Okay. Ooh, interesting. So one word before we go into the progressive system of what was the system before the progressive reform was introduced. As I mentioned, it was a presumptive tax system, so fixed fee by category. If you were a property built in non-durable material, you faced a fixed amount of 3,000 Congolese francs, and that was the case for like 90% of the properties. If you were built in durable material, so a cooked brick, not mud bricks, you were deemed high value band, higher amount of tax. And then there was a set of properties that had like a fancy amenity. So if you have a pool, if you have a TV antenna, etc. So again, still presumptive, you were deemed a villa and you were taxed at a much higher amount. Okay, so it's not, it's an interesting system, but that's the system we're moving away from in the sense that it is regressive in each of those categories, but there is a bit of progressivity, right? You have those three categories. But even if you want to be generous with that system, if you compare the tax rate, so this is now this system in percentage of the value of the property, the tax rate here on the y-axis, like even with the fact that it jumps in at those 3 points, still the lowest value property was taxed at a higher rate than the highest value property in that presumptive system. And so how do we move away from the system in partnership with the government? What we did is we designed a point-based mass assessment system in partnership with them. That was a lot of work, and we did this over a period of 2 years. More if I include the fundraising and finding like technical partners, etc. But for the implementation, it took about 2 years. And so that meant geolocating each building using their plus code. We also flew drone. We work with a drone company in Kinshasa. We flew drone in Kananga in order to have a good sense. So that helped with geolocating them, but also having good measure of the building area. That was an important component of valuing the properties. The government did surveys with in every single properties in the city. So that's, you know, by my record, that's quite a lot of surveys that were done, 136,000 and measuring 45 characteristics of those properties. And then, you know, despite all this work, you're not still done. We had to actually have a sense of how do we infer the value of those properties. And so for that, we worked with expert property evaluators from the cadastre division of the government for subsample that allowed us to connect. So they were in charge of estimating the value of properties. And then we could connect for those property, how did those characteristics from the drone and the survey predict, you know, the value for that sample. Then once we have all that, we can essentially fit a model that tells us what's the right way of value properties based on those characteristics and drone imagery, okay? And so the key output here was to build this uniform property valuation role for the entire city. Okay. And so once we were equipped with that, what we ended up doing, and I alluded to in the intro, so I'll be brief here, is essentially introducing different tax system across neighborhoods of the city randomly. We'll have our progressive system where tax rates increase with property value, and we'll contrast it with our proportional tax system that was a flat, a constant tax rate applied throughout the property value distribution. So if you want to do this is kind of this in a PF classical graph where we put the property value on the x-axis and the tax rate in percentage of the value of the property, and this is the tax rate that was actually implemented. In blue you have a proportional one, and in red was the progressive one. Okay, and so lower at the bottom, and then at the top higher, okay? Kind of echoing what I said in the introduction. We kept the expected revenue neutral, and we're rotating the tax schedule along the median liability, okay? The mean liability. So I'll skip this. And in terms of procedure, it was kind of simple. The collectors delivered bills to property owners that look like this, with the amounts, a picture of the property, and some text. Importantly, in the base letter, there was no mention of the tax system, so all people were facing was their own liability. And then they engaged in facilitation, so they visited houses to convince them to pay, and this was identical across treatment. Okay, so let's start talking about what happened in terms of revenue, and I'll mostly, for today, I'll mostly focus on revenue, effects, and mechanism, and conclude. And so what we see in the data is that progressive generates more revenue than proportional, okay? So this is an aggregate. I haven't told you where it comes from in the distribution, but if we just like lump all the payments, we see that progressive leads to more revenue than proportional system. So already a win for progressivity. We can do one more thing, which is to compare it with the status quo that we had ex ante. We have to do some adjustment because the status quo is not entirely comparable with the other one. It had different tax levels, and it's not a rotation along the curve, so we have to do some adjustment. Once we do some adjustment, we see that progressive also does better than the status quo tax system. Okay. What is interesting is if we start unpacking a little bit where the results come from and we start looking at revenue throughout the property value distribution, what we see is progressive does better throughout the property value distribution. Okay, so it's not just coming from rich property owners pay more, which would only mean that in the top band you get higher revenue. It actually comes throughout the property value distribution. And so what we tried to do next is understand why is that the case. And so this is a little bit of like going back to my motivation on the different forces at play. In order to understand this, we have to think carefully about in which part of the distribution of property value is the progressive system below the proportional, and in which part is it above. And so what we see is that in the part where it's below, like where progressive is below the proportional, if you remember from the mechanical effect, you should get less revenue. And so what needs to happen for it to generate more revenue is that you need to have compliance increase quite a lot in a way that compensate the mechanical revenue loss. And that's what we see. We see compliance jumping massively, more than 1-to-1, when the tax rate is lowered. So you get a lot more compliance when you lower tax rate. That generates kind of this increase in revenue. At the top, however, things are different. The tax rate is higher than in proportional. And so what it means is that to have a revenue gain, that means that your compliance response, there might be a drop in compliance, but it's not enough to offset the mechanical revenue gain, and that's what we see. There's a bit of a drop in compliance at the top, but not very significant and not very big. Okay, so that explains kind of the revenue effects. We can do more things, so that's kind of a fun one. We can leverage the change in the tax rate, and so there's a lot of like machinery behind to not just characterize how our progressive system is doing, but what an optimal progressive system would look like. And importantly, and so that is nice because then we can come back to the government and say, well, you know, this is what you should do if you want to maximize revenue. And so what we find is that revenue maximizing schedule is indeed progressive. Okay, and so that's helpful on multiple accounts. It helps us tell them what to do, and it also reassures us that it's not about kind of cherry picking one progressive system, or it's not about just giving a tax cut that leads to more revenue. It is really about the progressivity of the system that generates the increase in revenue. I have about 5 minutes, right, or something like that. I'm not quite sure. Okay, perfect. I will not bore you. The results are very robust, so that's all you need to know. One thing that's pretty neat is that the next year the government actually scaled up the progressive system to all neighborhoods of the city. And so we can look at, there's a lot of like concern when you scale up reform that things might look different at scale. It's not a one-to-one comparison because they also changed a little bit the tax rate. They actually they made it even more progressive because of what we saw at the bottom of the distribution. And they also increased enforcement at the top. So it's not a one-to-one comparison, but it's reassuring to see that the revenue are not lower, and if anything, they're going up. And so to us, that's kind of a nice test of both that it's sustainable, feasible at scale, or maybe there's not a lot of bureaucratic resistance as in Michael's setting, but revenues are kind of trending up, if anything. So in the 5 minutes I have left, I wanted to chat a little bit about mechanisms a little bit more deeply. So far, everything I've told you is along the lines of property owners responding to their own tax rates heavily, where lower value properties, when you introduce the progressive system, lower value property who face the lower rates enter the tax net, while compliance at the top doesn't drop much, and that generates also a revenue gain, okay? What I haven't talked about is whether people in the background of the results I've shown you are also responding to the progressivity of the system itself, right? Are they responding to other people's rate, learning about it, and kind of updating in terms of, and then affecting their compliance, okay? And so in particular, you could have the view that a progressive schedule might be perceived as fair, that strengthens tax morale, and that leads people to pay, okay? And so in order to test this, we did something a little bit similar to Michael, and we had to do it quite a few times because it is actually a little bit complex to convey. But what you should have in mind is fairly similar. We randomized information on the tax bill of the property owners, where some people received, so it's not shown here, they received just additional details about the property tax. Some people are just shown where they are in the distribution. This is to net out the fact that when you're told about progressivity, you're told both about the system, but also where you are. And so you might just update about the fact of being somewhere. And so we wanted to net that out. And then the one we care really about is people are told where they are in the distribution and what the tax system looks like. And so it looks like this, where you're told that your system is proportional, that's kind of horizontal here, or it's progressive, okay? And so that's the version we did in 2024. In 2025, we did it even better. We added some arrow from some comments we got from Michael and exchange, so we've done that a few times, okay? And so the question is, does this matter, receiving this information? If you really think people are responding primarily to their own rates, then you should find that most of the effect I've discussed with you are kind of floating on the control group, okay? If by contrast you think people care about their other people's rate, then you should start seeing different pattern, even stronger pattern maybe, for the ones that are receiving this location plus rates information. And so what do we see? Disappointingly, not much, okay? So that's kind of this. In the bar are for the control group, and then the dotted line are for the treatment, okay? And so if anything, we don't see an increase in compliance for those who receive the information, neither in proportional nor progressive. You might say, well, because people at the bottom are receiving good news, they know that they're facing lower liability, and people at the top are receiving bad news, they know the tax rates are higher. We don't find that that's the case. There's no treatment effect kind of throughout the distribution. And so we've been puzzled with these results for a while, and so what we've tried to make progress, and that's kind of the last bit I'll talk about, is why is that the case, okay? And so I accentuate this a few reasons. One is maybe, you know, that treatment was not very salient, the tax collector didn't read it, it's complicated, and so that's what explains the result. The other one is maybe people don't really value progressivity in this setting, okay? And the last one is maybe they value progressivity, but it's inframarginal to their decision. I care about my own rates, everyone else rates is kind of inframarginal for me, I don't care, okay? Because I'm cash constrained and I'm essentially, it doesn't matter for my decision. And so what we did is essentially, for the salience bit, we did look a bit at our data, and we do find that indeed there's kind of limited salience of the tax system. If you ask people where they think they are, in which of the tax system they think they are, they're doing a bit better than random, but they're not, they don't really know where they are in terms of the system. And so that is some evidence that at least in 2024, there was a bit of a salience issue. And so what did we do? We did a second bill experiment in the context of the scale-up, where we simplified the design of the letter so that, you know, we have nice arrows, it's less information for the taxpayers. And then it was much more enforced by the government. So actually they recorded, they made sure that it was read by the collector, the part with the information, and they did some monitoring, and there were some financial incentives if you're not doing a good job at reading that part of the bill. And so the results are still ongoing because the results came with the data freshly, but what we find is, again, not very much, okay? So comparing the placebo or even the own location flyer to own location flyer plus distribution, this is for people who receive information, get a bit of an increase, but nothing is significant. And again, throughout the property value distribution, I mean, maybe if you want to be very generous and compare those 2 points, maybe there's something, but not anything that reaches significance. The other interpretation is maybe progressivity is not what people want. They don't value it, and so that's why they're not really, we're not really seeing an effect. We don't find evidence that that's the case. We do have strong argument to show in our data that people value progressivity, kind of echoing some of the fact that Michael had. You can look at baseline. We did ask elicit preference for a progressive system. It's pretty strong. People want a progressive system, so that tracks. Another piece of evidence we have is we worked in our N-line survey to provide people retrospective information about the system they were in. Okay, so we tell the people who are in progressive that they were in a progressive system, and the proportional that they were in a proportional system, and then we measure their kind of perceived fairness of the different system along many different ways, and we find that on this kind of when we do this exercise, people think the progressive system is fair when they're told that they're in that system. Okay. And so to us, that suggests that it's not about people not valuing progressive system. They have strong preference for fairness, and our sense is that preference, what drives the lack of effect about others rate is mostly that others rates are inframarginal for people's compliance decision. Okay, they value progressivity, but ultimately what they care about is the tax system that they're facing. Okay. And so that's, I think I'm out of time or right on time, so I'll just go to the conclusion. You won't get some of the exciting technical part, but hopefully what I've conveyed is, that progressive taxation is a good policy lever to kind of increase revenue, and that maybe surprisingly it actually does so throughout the property value distribution, not just from the high value properties, where at the top you get higher revenue gains from the mechanical effect that dominates kind of compliance dropping. At the bottom, you get this kind of compliance boost that generates more revenue. There is limited evidence that others' rates play a role in the setting. And nicely and encouragingly, the scale up of the policy in the next year didn't lead to a drop in revenue. It actually surpassed the one of year one. There's more things that we're doing that we're excited about, but I'll stop here to stay right on time. Thanks.
Thank you, Augustin. That is fascinating research. Questions? Rock.
Two very quick things. The first one is about the compliance at the bottom. So I suppose this is at the extensive margin, meaning that like people who are not paying, now they start paying, or is there also an intensive margin component to it?
It's a bit of both, but it's mostly extensive margin.
Mostly extensive margin. So if that is the case, do you think also maybe tax enforcement by tax officers might have changed as well? Because perhaps now, okay, so the tax rate is lower. Now there's a high chance that, okay, if I,
that they're doing.
So is there any evidence for that?
Yeah, it's a great question. So like what you have in mind is like the tax collector in the progressive neighborhood, they start allocating their effort differently because they know that the system has changed. And actually it's, there could be reasons to do that if their compensation is tied to how much, revenue they collect. So what we've done is we work with so that was a concern we had ex ante. And so what we did is essentially, there's two ways to make progress on this. One was to adjust wage so that they're expected to be on average constant across treatment arm. And so we've done that for a subset of neighborhoods, and the results look the same. The other one is we had a set of properties where we kind of we call them random visits, where they couldn't schedule a visit. We told them, you should go on that property on that day, and we incentivize them to do so in order to have untargeted visits where they're not like choosing to target because of what they think the odds that the person will pay. We don't find evidence that there's a difference here. So in this context, we don't think that that's at play. When it scales up, that's something we want to continue thinking about, essentially. Yeah.
Thank you.
Thank you. That was really interesting. So I have a comment and a question. The comment is you missed a chance to pander to your audience because your co-author, Marina Mavungu, is an alum of our CDE program.
It's true.
And won like the best paper prize for writing a paper on tax policy here. The question is, I'm really interested in this result that despite the statutory progressivity, the effective tax rates decline with property value. So what accounts for that? Is it that the presumptive formula used to estimate property value undervalues property more for rich people, or is it to do with compliance?
It has to do with compliance. And so, yeah, so what we find, and this is kind of the summary of it, is like when we look at effective tax rates, and so the amount of revenue collected divided by the property value, we find that that's declining throughout the tax system. So this even for the progressive one. So the progressive one is de jure, or statutorily progressive, but effectively regressive. And so what we do in the second part of the paper is try to understand what can alleviate that. And we use some of the variations. So we've been doing a lot of work in 2025 and 2026 on enforcement with the government. And so we leverage some of that variation to show what type of enforcement action can restore that effective progressivity. And it turns out that enforcement itself is not enough, because if you just threaten enforcement throughout the property value distribution, poor property owners actually respond a little bit more. It could be because their liability is lower, and so it's easier for them to comply than for the rich. However, if you do targeted enforcement, if you put more effort at the top of the property value distribution, then you get that progressivity back. And so we have this nice, always dangerous to go back, but we have this nice slide here that shows what happened in 2025 when you put all the pieces together. It does become effectively progressive. But for that, the government had to do a few things. It lowered its enforcement effort at the bottom. It increased kind of its enforcement effort throughout the top part of the distribution, especially at the very top, where it actually, I have some nice pictures, some in the appendix, they actually padlocked properties that were delinquent for the most valuable ones. So once you do that, once you kind of reallocate your effort in that manner, then you get back that progressivity effectively as well, not just statutorily. Yeah. But it does require enforcement as well.
It's a really fascinating paper. I think I'm struggling a bit with progressivity in property taxes relative to progressivity with income. So if instead of viewing the progressivity in terms of just the value of the property, if you view it as a fraction of overall income, so for example, if rich people typically spend a smaller fraction of their disposable income on housing or tend to own properties that are smaller relative to their absolute incomes, do you still see it being as progressive? Or does it start to flatten a bit?
No, that's a great point. So we've done a bit of that, of like looking at how property value correlates with income, and it's very strong. And so that is reassuring. I think correlation is 0.7, so there's a strong correlation here. The second part to keep in mind is there is no income tax in that context. There is an income tax on the book, but it's only for formal workers, so or enumerators in our survey firm pay the income tax, but like this is a very small fraction of the population that pay the income tax. So the government is not really upset about the fact that some of it might capture income. To them, it's actually a nice thing, because ideally, maybe they would like to capture income, but they can't.
Different? Which is, if we think about, let's say for people who so yes, people with higher value properties are going to be higher income. But if we look at, say, the absolute relative dollar tax amount that a poor person is paying relative to their, right, as a fraction of their actual income. So you could end up with a system where the property tax itself is progressive in the value of the property, but if poor people basically have properties that are something like 50% of their income, and rich people have properties that are 10% of your income, if you take the actual property tax liability and turn it into what it would look like as an effective income tax rate, you could end up with something where poor people are paying, say, effectively a tax that's 10% of their income, whereas rich people end up paying a tax that's 1% of their income, even if they're paying a higher fraction as a percent of their property.
We could do something like, no, it's a great point. We could do something like that. I don't think that's the case, because the gradient of value is really steep. And so that's why like we have this kind of effective regressivity, is like the rich pay 5 times more than the poor, but their property value 60, 70 times more than the poor. And so you should think of like the lowest value property, I think in our sample, is $300. The highest value property is more than $100,000. So there's a really, really steep gradient that, my sense from having looked at the income survey data, so of course it has lots of imperfection, but it's if anything, as strong or potentially even less strong. Yeah. But it's a good point. We could do that in our data with the survey one. So that's a great point. We should.
come back to you, one of the students.
Thank you for your presentation. I'm Raisa from Cameroon. Sorry, I didn't follow you from the beginning, but I would like to know, did you come out with something that the government should do to incentivize the poor household in developing countries to comply with the property tax? Because most of the time, poor households don't even have a certificate of ownership, so the government have no way to penalize them if they don't comply with property tax.
Yeah, that's a great. So I guess some of the answer is simply asking them to pay less, right? So that's kind of what this schedule is doing, is kind of lowering the tax liability that they're facing, and so it's an easy way to do that. And the nice thing is that it's welfare improving. If you care about welfare, if you lower the tax rate for the bottom, some people are going to, those who continue paying, they're obviously better off. They're facing a lower liability, and then there's some people that will start paying when you lower the, but by from what we know about models, they should be kind of equally kind of off. They shouldn't be worse off, and you get more revenue. So it's kind of a nice win, and then you can use. So the second component is how you use that extra revenue that you're generating. Then there's nice work in PF of you can. If you use that revenue in smart way, you can get even more compliance toward the distribution. And so that's the other component of this.
I wanted to ask a question that's partly a plug for Mavish's work. So it seems to me that the combination of what you have shown is an increase in horizontal inequity at the top, right? The liabilities went up, but compliance went down. So that means the variance of tax paid within the rich has gone up, and the opposite for the poor. The liabilities went down and compliance went up, and so the variance of what you pay has gone down. How much do you think that matters? Could that explain some of the patterns you're seeing?
It's a good question. I'll have to think about this a little bit. Yeah, I'll have to look at the data a little bit more of how much that would explain the entire pattern. Yeah.
So I'm going to compound this problem of the horizontal and the vertical equity issues, because I think you mentioned a second ago the word padlocked. So we usually think about taxes a year is a year, but especially with the property tax, because it attaches to the property, it's easy for it to accumulate. So people become delinquent and so I'm guessing what you have is when you say poor people comply, you have people who comply year after year, and you have other people who don't comply year after year, but I'm not sure. And so I'm kind of trying to figure out how to think about that sort of dynamic issue of compliance.
So the short answer is we didn't really know before. So this is also the first time the government introduced the tax system. So I didn't mention this, but in the background, when they implemented the progressive reform, they also created, they worked on a tax software called MobTax that was implemented in other contexts in Sierra Leone and Senegal, for example, and they imported it in Congo, and it's been there since, so since 2024. That allows them to track over time who is paying or not. Before this reform, they had no sense. They're doing, they're giving a tax bill, they're, creating an address basically with a chalk that says you're taxpayer number one, and then the rain would wash out the chalk mark that they were making, and so they had no idea if you were paying over years. They could try to do it based on name, but they had very little sense. Now they can track things over time. And so
the tax rolls, it basically, you can't sell a property in the US if you're in arrears.
Yeah, exactly.
And
so here, and this is a hot political debates that we have with the government on what do they do about tax arrears, and that has emerged as a result of this reform that they weren't thinking about before, which is now they have a sense of not just how much you owe this year, but how much you've owned since 2024. And then, so far their policy have been to exonerate people from tax arrears. So any year is a kind of blank slate. But that's because there's low compliance to begin with, and they worry about demoralizing taxpayer. If you tell them you owe, hundreds of thousands of dollars, people are going to be, this is foolish. And so their sense is let's first build a sufficient kind of mass of compliers, and then we'll think about arrears. So I think that's going to be there. Maybe in 5 years I'll present papers on that. But yeah.
A question from an online.
Oh, online question.
Yes, that's
Great.
right. Yes. Thank you, Augustin. So I'm just passing along a question from an alum is viewing the talk online. And the question is basically having you a conjecture on how you think the VAT system might work out in the context of your conclusions.
Oh, that's a tough one. I mean, I think the VAT is really far from the equilibrium we have here. And so, you know, we'd love to have think about more instrument, but this is a context of, you know, low information. And so we're far from the paper trail and the capacity to monitor this. But the government is pretty savvy in terms of teching up and introducing technology in their system. And so my sense is going to, so right now they're not doing a lot of effort on small businesses, partly because they're all informal. They're doing a lot of effort on properties. My sense is as their capacity expands and when they'll feel like they're doing a good enough job on properties, then they'll start thinking about business tax and how to implement that. And that's where maybe discussion along the lines of, you know, what exactly do we do would play a role. Yeah.
Ethan. Hi, thanks for the talk. Do you have any measure of household size, and could variation in household size play any effect on individual earner progressivity? Like if you have many earners in the lower half of this distribution in one household, could the individual burden of
we do have survey data. We don't have, I don't think when they did the census of property that the government asked about the household size, because their view was they were trying to tax a property, not a household. And so I don't think that factored in their data collection, but we do have survey data and we could, I don't think we've looked into this. And that could be helpful to understand kind of what does the progressivity of the system look like in terms of income or, you know, along the lines that were discussed earlier. We could look into it. That would be nice to do, even for just knowing how progressive it is in terms of income or per, you know, worker, et cetera, et cetera. Yeah. So we haven't done that yet.
That's actually one of the cardinal features of thinking about property taxes. They are in rem, so they attach to the land, not to in personam.
Yeah.
They don't attach to people. And so property tax systems rarely know how many people are in a household. Other questions? We do have some snacks for break. I will make one observation. We've been talking about progressivity in the context of developing countries, but in the last few years, one of the most controversial things in Williamstown, despite being one of the places that is in the American politics, it's one of the bluest towns and one of the bluest counties and one of the bluest states. The potential to add a modicum of progressivity to the flat rate property tax got the knives out, shall we say. You know, the select board was at odds about a modest zero bracket amount for properties. And it was pretty stunning to me. And we don't have the compliance issues. I mean, the compliance is really, really high. So you don't have that behavioral margin, but just purely the politics of the progressivity of property taxation is fascinating. It's fascinating everywhere, but great. I want to thank Augustine. I want to thank Michael for a great start to the conference, and off we go for 15 minutes.
Everyone.